Smith, and I'm going to give an update on the Schroder Specialist Private Equity Fund, talking about the events for the past quarter and the outlook going forwards. So first of all, just to give an update on the past few years and the private equity marketplace, what we've seen since sort of 2022 especially is a real divergence between the performance of small, mid, large buyouts and venture capital. So we've tracked these here against MSCI World, and you can see that divergence starting to appear at the end. So what we're finding in the recent years is a lot of people have had quite a different experience in private equity, depending on the part of the market they're in and depending on the manager that they've partnered with. But as you can see, we focus on small to mid cap, and that's the part of the market that's still performing well versus large, and especially versus venture capital. Just to give a bit of a proof to the pudding, there's a lot of people talk about small to mid cap. So what do we mean by small to mid cap? We mean investing in funds that are lower than 2 billion, and you can see 80% of our fund investments are in funds smaller than 2 billion. And then when we look at our direct co-investments, the median enterprise value of those co-investments is 323 million. And we look at our GP-led program, so these are companies that have already gone through one round of ownership, so naturally are a little bit larger in size. You can see there the median enterprise value for those is 519 million. So really very much sitting in that small to mid cap sweet spot. We can also show our performance across our different strategies versus the market as well. And again, we're showing in each of these strategies an outperformance against the market. So when we look at our Western buyout, so this is small to mid cap in primarily North America and Europe, you can see that outperformance, and that's really started to exacerbate in the past few years. Again, Asia, this market's been a little bit more troubled, but we've again managed to outperform the index. And our venture capital program, again, has outperformed the Preqin Venture Capital Index. So really showing that through all our key areas of focus, we're able to deliver those returns that are outsized against the private equity indices. Also, there's been a lot of talk in the market about the fact that exits are troubled, companies are having trouble IPOing. There's a lot of stale companies within funds that haven't been exited. What we've shown here is our average percentage of the portfolio that we're selling in every year as a percentage of the starting portfolio. That was pretty average, around sort of 18 to 22% in the pre-COVID years. What happened in 2021 was that we had really good exits across our whole portfolio, and we also used that exuberant market to exit some of our venture capital positions. So you can see that we exited over 30% of our portfolio in 2021. As a result, 2022, 2023, 2024, a little bit lower than our average, but still at really healthy levels. And this again is our focus on the small to mid cap segment. So we're not reliant on IPOs to exit. We can sell to large private equity funds, we can sell to corporates in that same sector, or we can sell to secondary funds as well. So that focus on small to mid cap really gives us a lot more exit options and means that our exit percentage has actually been at a reasonably healthy level, which we're really pleased about. So just moving on to a bit of an update on the Schroder Specialist Private Equity Fund. You can see the allocation of the portfolio here as at 31st of May. So we've got that bulk of the fund sitting in small to mid buyout, 75%. We have a small sleeve of large buyouts at 12%. And then we've got our smaller allocations to growth, which is really mirroring that sort of Asia exposure, and a tiny sleeve of venture capital exposure through our secondary program. By region, when we first launched the fund, we anticipated having about 20% in Asia and about 80% in Western buyouts. But with the geopolitical situation, we've reduced the Asia exposure and really focused that more on India. We're being a little bit more cautious and opportunistic on China. But you can see the bulk of that fund, 90% sitting in the European and North American buyouts. By type, we've got a strong exposure to co-investments. That's one of the strongest performing parts of our platform, and obviously as well one of the most fee efficient parts of the platform. So that really helps with the overall performance and fee load of the fund. Also a large allocation to GP-led secondaries, where we see strong market dynamics and really interesting companies that we can underwrite for a second round of ownership. When it comes to sectors, you can see the bulk of that fund, just over 50% sitting across technology and healthcare, which are our two major sectors. We like those sectors because they've got good structural tailwinds, things like aging population, people living longer, digitalisation. And then by vintage, you can see the fund's been relatively well paced in investments over the past 5 years. So 6% invested in 2022, about 11% invested year to date, and then sort of between 16 and 28% in the vintages before that. So we're really pleased with the structure of the fund, well built out, and good allocations. Maybe just skipping on now to the performance. You can see the performance. The fund has just celebrated its 5-year anniversary, so we have 5 years of performance data, and really pleasingly, we've returned 15.7% net since inception, and every calendar year has been in that double digit region. 2025 has been a little bit more challenged. The market, obviously, there's a lot of volatility, a lot of uncertainty, but still delivering good returns year to date. I thought I'd go through a couple of exit examples to highlight the strength of the platforms, the types of investments we enter into, and how we're able to exit these, even whilst the OPM market is a little bit slower. So the first one is a pharmaceutical company called Essential Pharma. This was a UK company, a founder-owned business, and we invested, and the plan there was to transition out the founder and replace with a C-suite, of a professional C-suite of C-suite executives. Also, we helped them expand from the UK into continental Europe, and we helped them add other drugs, rare disease drugs, to the product line. So this has all been a very successful transition. We've successfully transitioned the founder out. We've made those product line changes. We've made those regional changes as well. So because this was a smaller company, still family owned, we were able to enter at a really attractive entry multiple. We doubled effectively the revenue of the company, and then because we professionalized the company, we were able to sell up market to a higher bidder. So they effectively paid us an increase of 5 times the multiple we paid on that company. That, coupled with the doubling of the revenue, meant that we've made 2.8 times net on that investment since inception, and we actually sold that to a secondaries fund. So again, showing that these companies that have these strong tailwinds, this sort of grow, transform strategy has really worked well. Moving on to another example, this is Optegra. This is some leading ophthalmology clinics, really operating in the UK, Poland, and Czech Republic. Again, we've helped them to enter new regions, so Slovakia and the Netherlands are new regions. They've done 8 add-on acquisitions as well, and then some new stores in the UK to help capture that growth. Again, we were able to benefit from that, buying at a really attractive entry multiple and grow, and then selling up market at a higher multiple. We grew the EBITDA by 50%, and we sold that up market to a larger corporate in that same sector. And that's generated for us a 2.2 times net money. Moving on to the outlook. Obviously, we're in a bit of a transition phase. There's a lot of volatility in markets. There's a lot of changes that we see coming through. We're expecting more uncertainty. We're expecting more innovation and disruption. We're going from, I guess, a sort of a bipolar, a single polar country regime to a multipolar, and all this is creating new threats and new issues to be aware of. But when we look across our portfolio, we're still quite happy with the structure of our fund and the companies we're investing into, because what we're really doing is, with the small to mid-cap focus, we're finding small to mid-cap companies around the world that each have their own idiosyncratic risks. They're also, because they're smaller, they're not really reliant on global trade. They're usually local to local businesses. And as I said, each company has its own risks that will either fail or succeed, usually as a result of the workings of that individual company, rather than GDP or large macro headwinds. So small to local to local helps insulate from tariff risk. When we look across the portfolio, only 5% of the portfolio we anticipate to be affected by tariffs. And again, we've got this nice balanced exposure. There's about 270 individual companies within the fund, and each of them have their own individual risk return drivers. So we're feeling reasonably comfortable with the portfolio from that perspective. So just quickly to recap on the fund and the strategy and how we're thinking about the world moving forwards, we're pretty confident with the strategy of the fund. So we're investing in segments of the market that have good supply-demand dynamics. We find the small to mid-cap part of the market, there's a lot of companies to choose from and less dollars of capital chasing those, which creates obviously attractive entry prices. There's just a large universe of companies to select from as well, and we can really try to find companies that are diversifying from each other and diversifying from listed markets. We're looking for companies that can grow and transform through change within that business. So whether that's, rotating out a founder, entering new markets, adding new products, these are quite idiosyncratic risks that we're trying to look for within these companies. focusing on businesses that can pass through inflation. So obviously healthcare, technology are really good at passing through inflationary pressures because they're often mission critical software or healthcare that people require regardless of the market environment. And finally, the companies that we invest into tend to have a lot lower leverage of debt. We've never really used debt as a value driver in the past, and we won't look to use that going forwards. So with interest rates, bouncing around at the moment, again, that's not really providing too much risk within the portfolio, given the lower leverage of our companies within the fund. So that's it for today. Thank you very much.